Good morning, I'm Bill Hubbard, Chief Economist at Trade.com, and welcome to our weekly market review here at Core Finance. And I'm pleased to say our special guest today is Mike Ingram, who is Chief Strategist or just General Strategist at BGC Partners. And I guess, Mike, it's a question of, we only have about 15 minutes, but we can discuss this for the next 3 or 4 days. Bank of England, Federal Reserve, Magic Mario at Jackson Hole, and the employment picture in the States. So let's start with the Bank of England from last Thursday.
Sure. So perhaps no surprise in terms of what they did in terms of their most recent inflation report. It was very clear that GDP growth number, which had been trimmed in May from 2% forecast for this year to 1.9, needed to come back further still. You know, we banked 0.2 in the first quarter. We were living with a 0.3 number in the second quarter, and it looks as though 0.3 is probably going to be the outcome for the current quarter. So that number had to come down, and of course they did trim that 1.7 down to 1.7%. And 1.6% for 2018. Didn't do much with the inflation target, because obviously they've been blindsided a little bit on that. They were underestimating the inflationary impulse, certainly for going into the year. But the most recent inflation print obviously took a bit of the steam out of that. There was an unexpected decline to 2.7% on the headline. The core number also came down. So a lot of that rhetoric that you were seeing at the time of Sintra in June, you know, Carney doing his, you know, cage rattling, and Mario Draghi sounding hawkish, Janet Yellen also sounding quite hawkish on the Hill, to some extent dialed back. But then, of course, you know, Carney is to some extent conditioned all of that by saying, well, look, you know, the market isn't terribly prepared for a harder Brexit. Most businesses, the consumer is generally assuming that everything will work out more or less okay in the end. And he foreshadowed the Bank of England agent survey, which was only...
Let's look at, you know...
Yeah, why not?
So as you say, you know, we had, again, the Bank of England, okay? Now, the key here is, you know, the market feeling which we got was a 5-2 vote, okay, because Kirsten Forbes had gone off, and Haldane was sort of said, well, maybe I shouldn't have said what I said and stuff like that.
Haldane's the James Bullard of the Bank of England.
But I think one of the things is, if you look at the probability, I mean, the market's still only saying not even a 25% probability of a rate hike this year, okay? And my feeling is, unless it changes dramatically, the earliest I am looking for a rate hike is May of next year. And there are people that are saying we may not get any decision until the Brexit divorce bill is signed, and that's May of 2019 or March of 2019.
Yeah, I mean, what Carney said in the presser last Thursday was that he thought that the two rate hikes over 3 years, which is their forecast horizon, effectively, was insufficient. So he was trying to be, you know, trying to be sound a somewhat hawkish note. Although, you know, I can imagine that you'd probably be saying this, certainly you'd be getting the same message out of the Federal Reserve, saying, well, markets are far too relaxed about the trajectory of where interest rates are going. But, you know, look at the market reaction. Market reaction was like, well, we don't believe a word of this.
Yes.
You saw bonds rally, you saw sterling weaken. So, you know, the message at the Bank of England, well, you know, markets, you know, really need to be firming up those curves, and actually went the other way. And to be honest with you, you know, looking at the track record over the last 4 years or so, who can blame them?
Because I think the interesting thing is, you know, and we were talking about this before, you know, Fed, the Bank of England, the European Central Bank, this magic 2%. To me, this is the most meaningless number in the whole world. And I guess I'll look back to October of '79. Inflation in the States, 28.9%. That's inflation. Here, they get concerned if inflation is not even at 2%.
Yeah. Well, I mean, there are many moving parts of this, aren't there? One, at least of which is, you know, are we measuring inflation appropriately?
Yes, exactly right.
And many have argued, particularly post Great Financial Crisis, that actually, if we'd factored in asset price inflation, rather more, we'd been tightening. Central banks would have been tightening earlier into the cycle. We wouldn't have inflated that huge risk bubble, and we wouldn't have faced, you know, the consequences of the aftermath.
I think one of the things that maybe people don't understand is the composition, whether it be the PPI or the CPI or the PCE, which is the Fed's preferred.
Yeah.
This is adjusted. okay?
Yes.
I mean, 10 years ago, laptops and mobile phones,
Yes.
okay, were not included
Yes.
in the inflation numbers. And as we saw, one of the major reasons why we saw a dramatic fall in inflation was a dramatic drop in mobile phone costs.
So it's so-called hedonic adjustments, or hedonistic adjustments, I would say sometimes. But yeah, so it's adjusted effectively for the quality, because we all know that the computer with the spec that I built
Yes.
a year ago is probably, the price has probably gone by 20 to 30%
Yes.
over the last 12 months.
And I think one of the things, again, we're looking at the Fed, okay? I mean, we saw a very, very strong jobs number last Friday, and then this week the JOLTS number, which was at an all-time historical high, saying that for real jobs, and we're talking maybe plumbers, maybe carpenters, people that we would not even think, there's a dramatic shortage. And we saw this yesterday from the Bank of England agent saying we are seeing, especially up north, we're seeing real job inflation numbers, because it's a question of, we'd like, we need 25 plumbers. One guy shows up.
Well, if you look through the sort of the month-on-month volatility, evidenced by various surveys, be the ADP or the non-farms or things like JOLTS, if you look at the sort of 6-month and 12-month averages for non-farms, it's averaging just a shade below 180,000 per month. Now, the Fed, on many occasions, has said it considers stable employment growth to be between 75 and 125. So let's say 100 in the middle. We're 80% above that at the moment. So there's no doubt that by most measures, the job market in the US is continuing to tighten. The job market in the UK is continuing to tighten.
The interesting thing is, and I won't say the name, but a major US brokerage firm, okay, after last Friday's non-farm payroll, basically was talking about the evolution of jobs. Now I'm going to call it footfall to phone call. It was talking about the number of people who've lost jobs in departmental stores, in shopping malls, where again those jobs are being lost to our good friends at Amazon. So what you're seeing, as I say, these are lower paying jobs being taken over. Again, maybe it's just $1 million for $1 million, okay? By people who are getting even lower wages. So therefore, again, we're seeing a tightness in the market, but we're not going to see that increase in average hourly earnings, because we're not talking about people looking at $50 an hour jobs.
And it also explains why you're not seeing consumption being as strong, because you will say, well, there are plenty of jobs, isn't it? But those jobs aren't paying. It's more vicarious employment, so you don't know necessarily you're going to be in that job in a week's time. What are you going to do? You're going to tend to build up your savings.
We saw it last week, okay, when we got the automobile statistics from the States. I mean, it was like the worst month in ages. I mean, we're talking 2 or 3 years. And they were interviewing, okay, I think CNBC was interviewing probably one of the number one dealer in Detroit. And he's saying, our business is very good, but we can't sell a 2 or 4-door sedan. But we can sell SUVs because everybody needs to take the kids to school, or they're doing DIYs, okay? So it's a situation where until we change, and it's just like when I was growing up, okay? The people that were selling Cadillacs and Rolls Royce and stuff, it says, they kept saying, what is a Volkswagen, Daddy? Because everybody went from gas guzzlers, and that slight problem was 73 and 74, and that's what he was saying. He says, Detroit hasn't made the evolution to who is actually buying automobiles right now.
Exactly. Look, we're going through a period of very deep structural change in terms of where employment growth is, how people are employed, or even choose to be employed. Sometimes they have no choice. How that employment is taxed. I mean, that was one of the issues arising out of the last UK budget. Because we were saying, well, our personal taxation system is no longer fit for purpose. We're not capturing this growth in self-employment. So there are many issues at all, and this is why I think that to some extent the thinking out of many policymakers has been very, very rigid. They said, well, this is outside the range it used to be, and and we should be acting like this and that, and I think quite often you're ending up with the wrong policy prescription. So, for instance, to go back to the inflation situation in the US, I argued 2 years ago. in another venue, shall we say, a competitor, that, again, there's nothing particularly magical about that 2% inflation target. And I said, look, we're looking at structurally lower inflation. There is ultimately going to be a trade-off between financial stability, particularly in a market-intermediated financial system like the US, where, if you don't believe interest rates are going to go up, the stock markets go up, the bond markets rally, and that itself generates a loosening in financial conditions, irrespective of where the interest rate, policy rates are. Eventually, you're in a situation by pursuing a 2% inflation target and saying, well, we're not going to raise rates until we think that we're going to reach that. You're allowing markets to pump up and pump up. You're actually loosening monetary policy further and further and further, and you're just going to end up engendering asset bubbles. Now, that's good news for investors potentially. The problem I have with this is it has become apparent, I think, even to many policymakers now, and I think that explains some of the shift in rhetoric we've seen, particularly from the Fed over the summer, where they were saying, well, look, we're sticking with this dot plot. We're talking about residual seasonality, weakness in the first quarter, etc. Of course, that's looking a little bit threadbare right now. But at the end of the day, they for the first time, they were actually talking about asset bubbles. They're talking about the S&P, for instance.
Because again, one of the markets looking at is Dudley is speaking today, okay,
Yes.
the New York Fed. And basically, he is more towards a hawkish dove, if you will.
Yeah.
And I mean, right now, market only applying an 8% probability in September, but that feeling is that they will announce the reduction in the
tapering effective October quarter.
And you're probably about a 40% for December. So my feeling is, I think they will move in December, and I think we will look at 2 hikes next year.
Yeah.
But I mean, we're still not anywhere close to 16, 17, or 8% Fed funds, which we knew years ago.
Well, again, look at the chart. So you've got the effective Fed funds at the bottom. So that's in the range of 1 to 1.25. It's actually 1.16 most of the time. In terms of where they think rates are going to be, I mean, I did January because it obviously the way it averages out. But anyway, as you say, pretty much a coin flip as to whether they get one more, that third rate hike, which is in the dot plot for the Fed. But for next year, you're saying 2, the Fed's saying 3, the market's saying 1. The market's saying 1 for next year. It never bought into 3 at any point in time.
No.
And actually, if you look at that trend, certainly over the last 5 months or so, that's been firmly down.
Yeah, and also what you're talking about, so many of the models that the Fed uses, whether it be, the Taylor rule, okay, et cetera, okay?
Yes.
Because of the way the global markets have changed, so much of the input numbers don't have the same meaning or will have the same impact. So I think that's one of the things when, because Janet Yellen's term expires on the 31st of January next year, okay? Are they talking about, do we want a market individual rather than an economist?
Yeah, I think I'm glad you mentioned that actually, because I think one of the things which may also help temper interest rate expectations going into 2018 and beyond is we're not hearing much about Janet Yellen being replaced anymore. We were hearing about John Taylor, which you referenced. We're talking about Kevin Warsh, both of which would be significantly more hawkish. I mean, if you look at the Taylor rule at the moment, the various versions of it, that would be talking about Fed funds at 3.5% with the input numbers that you've got at the moment on inflation and employment, or unemployment. So, the fact that, Trump, of course, Trump says, oh, well, there's a low interest rate in person, and I like low interest rates. Interesting enough, when we had an Obama presidency, he wasn't in favor of low interest rates because that was, seen as support for the Democrat Party. So everything seemed through a partisan prism. But, you have to say, look, on paper, he could completely remake the Fed, and if he appoints dovish governors.
Yeah, I guess I know this is very difficult. As a simple fact is, had he gotten probably any of his administration chores done, Obamacare or infrastructure. I mean, right now everybody is saying it's like the only thing they're concerned about is will the U.S. or won't the U.S. attack Korea? Okay, I mean geopolitics is this week. Forget Obamacare and everything else. Now let's see what the last chart you've got up there. Sure. But I mean, I think it's a situation where looking at the currency. Okay, again, I am negative sterling, because I think, we ain't seen nothing yet. And I mean, as I said yesterday in a report, the only reason we were above 130 was the geopolitics. My feeling is,
And the dollar.
Yes, exactly right. And the simple fact is, and this is why the people that are talking maybe dollar yen going to 111 rather than 108, it may all come down to tomorrow's CPI number, okay? And then, of course, next week here in the UK, we got retail sales, we got the employment picture, and we got inflation. So therefore, we got economic data for sterling next week from the politics and maybe away from Brexit. But as you say, it's a situation where, as we were talking before, looking at the CFTC numbers, in reference to sterling, in reference to the euro, in reference to the dollar, this is almost becoming more of a technical.
Yeah, it's about positioning and
Market.
flow. I mean, again, if you look at the sort of the money market futures positioning, I mean, you're talking about a US dollar position at a 4.5-year low. Well, in terms of net short, it was net short, and it just seems a bit overcooked.
Well, as you see right now,
the Fed surprise on the upside on rates.
Look at if you want to say the Trump surprise, okay, and then all of a sudden,
Trump bump slump.
the Trump bump, as you said, the Trump bump, and now the slump.
Yeah.
And I mean, as you see, it only went one way going into the election, and it's only gone one way.
And it kicked, and it's illustrated by this chart actually. It kicked into high gear as we got into April, because what happened, for years, in fact, you had the euro as a structural short.
Yes.
And of course, going into this year, you had everybody saying, well, it's only a matter of time until it goes to parity with the dollar. Only a matter of time. Of course, it's gone precisely the opposite way. And that structural net short on euros on the spec positions was then building into a net long.
Last comment here. Okay, now we've talked about the Bank of England. We've talked about the Federal Reserve. What about Magic Mario on the 24th of August when he's at Jackson Hole? Your last comment here on, will he take back his comments from the Sintra and see the euro going down to 110 rather than to 125 against the dollar?
Well, he's dialed back a bit on Sintra, hasn't he?
Yes.
In the latest MPC meeting. I wonder, because the last time he appeared at Jackson Hole was 2014. He hasn't been there for 3 years. And there he effectively pre-launched QE.
That's exactly right.
I'm wondering if he's going to effectively pre-launch QT this time round. It'd be very interesting to see what he has to say. One thing is for sure, where we're seeing the euro trade at the moment, these sort of levels, historically is where the ECB started to roll out verbal intervention,
Exactly right.
And then subsequently denied it than any such thing. But you look at the transcripts, they are in the pain zone at the moment.
Well, we will leave our viewers with the pain zone. Mike, I want to say thank you very much, and we will see you next month.
For it.
And thank you very much, and have a lovely weekend.